Alright, listen up. You hear the word stock market on the news every single day. Dow up, Nasdaq down. It sounds complicated, right? Like some secret club for suits on Wall Street. But let me tell you, it's not. Booyah! It's simpler than you think. Imagine a company, best darn widgets in the world. To grow bigger, build new factories, hire more people, invent even better widgets, it needs money. Cold, hard cash. So what does it do? It sells tiny little pieces of itself to people like you and me. Those little pieces are called stocks or shares. You buy a share, you own a sliver of that company. It's that simple. So, where does the market part come in? That's the genius of it all. A stock market is just a giant marketplace. Bustling, modern stock exchange floor with traders looking at large screens showing stock tickers and graphs. It's a financial flea market where people can buy and sell these shares. It's not some back alley deal, it's an organized system. This constant buying and selling makes prices go up and down. It's about getting a piece of the American dream. Let's get in the time machine. We're going way back to 1792. No fancy computers, no high-speed internet, no CNBC ticker at the bottom of your screen. There's a dusty street in New York City called Wall Street. It gets its name from an actual wooden wall built by the Dutch to keep people out. But now, it's becoming a hub of commerce. People are buying and selling stuff, including something new. Government bonds. The US was a brand new country, fresh off the Revolutionary War. Alexander Hamilton, the first Treasury Secretary, a real visionary. He issued bonds to raise money. But the trading was a mess. It was chaos. Brokers would meet on the street, shouting prices, cutting side deals in coffee houses. It was the Wild West of finance. On a spring day, May 17, 1792, 24 brokers gathered under a buttonwood tree outside 68 Wall Street. A tree. Can you believe it? They drafted and signed a simple, two-sentence document. This legendary piece of paper became known as the Buttonwood Agreement. It was a gentleman's agreement, a handshake deal that would change the world of finance forever. It was the birth certificate of what would become the New York Stock Exchange. The Buttonwood Agreement was the spark, but you can't trade under a tree forever, right? They started by renting a room in the Tontine Coffee House. As America grew, so did the need for capital. The Industrial Revolution was kicking into high gear. Canals, railroads, factories. These massive projects needed massive amounts of money, more than any single person or bank could provide. The answer? Selling stock to the public. The Brokers' Little Club officially organized in 1817 as the New York Stock and Exchange Board. They rented space at 40 Wall Street. They established more formal rules of trading. For the first time, there was a continuous auction for stocks, not just a daily call. The invention of the stock ticker in 1867 was a game changer. Real-time price info could be sent across the country via telegraph wires. Investors in San Francisco could know the price of a railroad stock in New York almost instantly. Vanderbilt's, Carnegie's, Rockefellers. Railroads, steel, oil, electricity. The NYSE moved to its current iconic building at 11 Wall Street in 1903. A grand temple of commerce with its massive Corinthian columns and a cavernous trading floor. In 1971, something completely different arrived. The Nasdaq, the world's first electronic stock market, a network of computers. Picture the roaring 20s. World War I is over. America is feeling good, jazz music is playing, people are dancing the Charleston, the economy is humming. It was a time of incredible optimism. New technologies like the automobile, new technologies like the radio. And on Wall Street, the party was just getting started. The stock market was going up, up, up. It seemed like a sure thing. Stories were everywhere of waitresses making fortunes, shoeshine boys making fortunes, factory workers making fortunes. For the first time, regular people were piling into the market, not just the wealthy elite. The problem was, this wasn't just about investing in good companies. A dangerous fever had taken hold. Speculation. Worse, many were buying on margin. This meant they only had to put down a small percentage, maybe 10%, of the stock's price, and could borrow the rest from their broker. The market became a house of cards built on a mountain of debt, and the higher it went, the more unstable it became. The music stopped on October 24, 1929, Black Thursday. Panic set in. On Black Monday, October 28th, the Dow plunged nearly 13%. The next day, Black Tuesday, it fell another 12%. People saw their life savings, their hopes, their dreams, wiped out in a matter of hours. The Great Crash of 1929 was more than just a market downturn. It was a national trauma that shattered confidence and was a major catalyst for the Great Depression. After the devastation of the 1929 crash and the Great Depression, the American people were angry and scared. They had lost faith in Wall Street. Honestly, who could blame them? The government, under President Franklin D. Roosevelt, knew it had to act. It couldn't be the Wild West anymore. Landmark laws in the 1930s, FDR's New Deal, aimed to clean up finance and protect investors. It was a monumental shift. Uncle Sam was stepping in as the referee. The most important change? Creation of the Securities and Exchange Commission, the SEC, in 1934. Think of the SEC as the police force for the stock market. Its job? Protect investors. Maintain fair and orderly markets. Make sure companies tell the truth. The Glass-Steagall Act separated commercial banking, where you keep your savings, from investment banking, the riskier Wall Street side. Companies had to file regular financial reports so investors could see what was going on. No more hiding the numbers. Rules brought transparency and accountability to a system that had operated in the shadows. With these safeguards and the end of World War II, America entered unprecedented economic growth. Soldiers returned home, they started families, they bought houses in the suburbs, they filled those homes with new appliances, cars, televisions, refrigerators. This prosperity fueled a long, steady bull market for decades. It wasn't the frenzied bubble of the 20s, and a growing middle class beginning to invest for the long term. Mutual funds gained popularity, allowing everyday people to buy a basket of stocks managed by a professional. The cop was on the beat, and that made all the difference. Fast forward to the 1980s. Greed is good. Gordon Gekko, big shoulder pads. The market was roaring again. This time the computers were in charge. Program trading became a huge force. Computers were set to automatically buy or sell large blocks of stock when price levels were hit. But on October 19, 1987, Black Monday, it created a terrifying downward spiral. The market started falling, triggering computer programs to sell, pushing the market down further, triggering more selling. Boom! The Dow plunged 508 points, down 22.6% in a single day. The largest one-day percentage drop in Dow history. Black Monday was a stark reminder of how fast things can go wrong. It led to circuit breakers, temporary trading halts to break panic cycles. Then came the 1990s, the rise of the internet. Not just a technology, an everything-changing revolution. And with it, the dot-com bubble. Any company with a .com drew frenzied attention. Business plan, profits, irrelevant. All that mattered, eyeballs and growth. The Nasdaq went parabolic, under 1,000 in 1995 to over 5,000 by early 2000. Roaring 20s vibes, with fiber optics and dial-up. Of course the party ended, March 2000. The bubble burst, spectacularly. Pets.com, Webvan, eToys, Nasdaq crashed, nearly 80% down over 2 years. Another painful lesson, technology doesn't trump business fundamentals. A company still needs to make money. After the dot-com bust, you'd think we would have learned our lesson about bubbles. But greed has a short memory. In the mid-2000s, a new bubble began, not in tech stocks but in real estate. House prices were soaring across the country. They're not making any more land, housing prices can only go up. Lenders were giving mortgages to just about anyone, even those with bad credit and no income. These were called subprime mortgages. It was free money. Everyone was getting in on the action, buying houses to live in, to rent out, to flip for a quick profit. Wall Street poured gasoline on the fire. Investment banks took thousands of risky subprime mortgages, bundled them into complex financial products, mortgage-backed securities, collateralized debt obligations, and sold them worldwide. Credit rating agencies, the supposed watchdogs, stamped these toxic bundles AAA, calling them as safe as government bonds. A house of cards built on the fantasy that prices would never fall. And then they did. Starting in 2007, housing prices wobbled and fell. Homeowners with subprime loans and teaser rates that jumped, couldn't afford payments, and couldn't refinance because homes were worth less than loans. Defaults skyrocketed. Those AAA-rated mortgage-backed securities were revealed to be filled with junk. Panic spread across the financial system. Nobody knew who held the toxic debt. Banks stopped trusting each other. The climax, September 2008. Lehman Brothers, a 158-year-old institution, declared bankruptcy. The government and the Fed had to step in with massive bailouts. The Great Recession followed, the worst since the Great Depression. For most of its history, the stock market was an exclusive club. You needed a lot of money, a personal relationship with a broker, and a suit, hefty commissions for every trade. But over the last 50 years, a quiet revolution, the democratization of finance, has been taking place. The first big step was discount brokerages in the 1970s after deregulation of commission fees. Firms like Charles Schwab offered no-frills trade execution. Then came mutual funds and index funds pioneered by Jack Bogle at Vanguard. Instead of trying to beat the market, buy the whole market, the internet, and later the smartphone, changed everything. No need to call a broker. Log on from your home computer. E-Trade's baby ad captured that spirit. The power was in your hands. Recently, it's gotten even easier and cheaper. Apps like Robinhood brought zero commission trading. You can buy or sell a stock by a fraction of a single share from your phone for free while waiting in line for a coffee. This access is incredible, a triumph of technology and competition. But it can be a double-edged sword. Easier to invest for the long term, but also easier to speculate, to day trade, to get swept up in meme stock frenzies like GameStop and AMC. So where do we go from here? We stand today, September 14, 2025, at a fascinating crossroads. The stock market has survived wars, depressions, crashes, pandemics. It has adapted and evolved from a buttonwood tree to a global network of supercomputers. The future is happening right now. The biggest disruptor on the scene is undoubtedly cryptocurrency blockchain technology. Bitcoin, Ethereum, you hear these names everywhere. At the same time, artificial intelligence, or AI, is transforming the world of investing in a different way. We're talking about sophisticated AI algorithms. They can analyze millions of data points, all in the blink of an eye. The fundamental principles, however, remain the same. Railroad, 1880s, .com, 1990s, AI company, 2025. You are buying a piece of a business. You are betting on human ingenuity growth, the future. Do your homework, be patient. Think for the long term.